Welcome to the Legally Ever After Real Estate Podcast, where we help you build, protect, and pass on your assets. I'm your host, estate planning attorney, Pamela Moss-Garrett. Let's get started. All right. Today we have Chris Lopez. He has an ecosystem that helps real estate investors, podcaster, author, software, influencer, so many different things. And today we're going to be talking about the wealth building mechanics for real estate. Thanks so much for being here, Chris.
Yeah, I'm happy to be here, Pam, and I love talking about these topics. So I am jazzed up and caffeinated to hopefully not put people to sleep with a bunch of metrics and details, but enough to understand it and keep them awake.
I love that. Let's dig into it. So for real estate investors, either people kind of starting out or people that are more experienced, you have so much knowledge. What do you want to start with from a wealth building mechanics component?
I always like to start at the very, very basics. And that, in my mind, kind of really always starts with the individual person, like the investor, him or herself, or, partnership or couple. Because so many people go out there and they get started and they start with a lot of times their reference point is like stock market, bond market. That's a lot of times everyone's anchor. And they go out there and start listening to podcasts or Googling, different real estate investing topics. And you get quickly inundated with, well, how did I make this work for me? How did this guy go from living in a van to having 3 billion units in 20 months and, all this stuff? And it can be very overwhelming. And what makes real estate so attractive is that there is a lot of opportunity in there to apply methods and to apply strategies and to apply time to go out there and earn extraordinary returns, where the stock market is relatively kind of like set it and forget it. But real estate is not, and takes a much different mindset and a totally different learning curve to go there. So I always break things down to like 3 main sections, help people either get their starting point or to, grow from where they're at. So if you think of like 3 circles, one circle is the person's goals. I'll say goals and situation. Hey, who are you? What's your situation? What do you want to do? What don't you want to do? What money do you have to invest? Where do you want to go? Because it's very different if someone is, like us, where, hey, we're busy professionals with spouse, with families. We have not much time, but, more capital than we did when we were 22. But going back to like 22-year-old Chris and probably 22-year-old Pam, less money, but more time. So a lot of it really just depends on what that person's situation is. And I have found it fascinating because so many people have like boxed themselves into like, oh, well, I can't do this. Or they try to make someone else's like situation work for them. No. Be true to yourself, because the square peg round hole is not a great recipe for success. Plus, that's what causes friction and people laying awake at 2:00 in the morning stressing about things. Like
I love that. Yeah, I love that. It's that self-awareness piece and kind of knowing who you are and having that clarity is so important.
Exactly. And I think that is like foundational. The second thing is looking at what type of strategy do you want to implement? And that runs the gamut. And, typical strategy is I want to go out there and fix and flip, or I want to go out there and buy a long-term rental. Hey, those are both very common strategies. But, now there's Airbnbs, there's out-of-state investing, there's medium-term rentals, there's the BRRRR strategy, there's passive investing, there's note investing, there's lots of strategies out there. Again, not right or wrong. A lot of that depends on what's the right fit for the person based on their time, their experience, their capital, and also what market they are in or not in. So that's the second circle. The third one is what market do you want to invest in? And I say market, I mean like a geographic market. You and I are Denver based, so we talk about Denver, Pam. And that's very much, my home base, and where the vast majority of my investments are is here in Denver. And what people do is they will go read a strategy or listen to a podcast that was done in a different market at a different time. Like, oh, I want to do this. I'm like, hey, that's great. What you want to do does not work in today's market, nor does it work in Denver. So not right or wrong, but I don't really care what you want and what your expectations are. But if those are not realistic with the market you want to invest in, then we have a problem here. You either need to change what you're doing or change the market, because the market doesn't give a damn what you want to do, So you have to adapt to it. So you have those 3 areas, and if you think like 3 concentric circles, where they overlap. That's the sweet spot. That's where I say, hey, if you have that, you have enough of your strategy and enough of your buy box dialed in to go out there and start taking smart action. And of course, evolve it more.
I love that. It's the Venn diagram, essentially.
Yes. Yeah, that's the real term for it. So I think that's very important for people to kind of like have a very realistic assessment of themselves, the market, and the strategy. And they can then do it on a continual basis because life changes, economy changes, and market changes.
That's so important. And I think that like touching on, it's so helpful. I know you have a really successful podcast. It's so helpful to go out there and see what's happening and get that advice. But then if those three circles don't really line up, then it's not really going to be setting you up for success. And so once you have that in place, what is kind of the mechanics or the return on real estate that investors need to know about?
Yeah, and there's really kind of two hurdles, or I don't want to say hurdles, but two like roadblocks I see investors get into. The first is, are you an investor or are you starting a business? A lot of times people kind of like get the two mixed up because I mentioned, hey, a fix and flip or a long-term rental. And in my mind, a fix and flip is starting a business. I mean, it takes a lot of time, effort. There's risks involved. You have to source deals. You have to be a GC. You have to rehab. You have to have financing in place. You're starting a business. Where if you go out there and buy a long-term rental, I put that more as investing. And so I think it's very important for people to realize, hey, am I investing or am I starting a business? Now, the vast majority of people I work with, are investors. But for example, my business is in real estate as a broker, helping people invest. I also invest myself. So it's very good to have people have clarity. Hey, is this a business you're starting or is it actually a true investment? Now, a lot of times they can overlap in people's strategies, but it's very important to label that because I see people get very confused on that. Because a fix and flip is great. Hey, make $30,000. Hey, that's the job. That's a one-time thing. Not right or wrong, but that's not building wealth. That is just you're self-employed now.
Mm-hmm.
The second aspect, and kind of going along the investing, because I think that's what's important in real estate is the investment opportunity. It's actually understanding how real estate returns your money and actually makes your return. Again, a lot of people go back and use the stock market as a reference point. Like, hey, the stock market makes me 10% a year. And they use that and they say, okay, well, if I can make 10% of the stock market, if I go out here and buy this property and I get a 5% cash on cash return, well, why would I do it? The stock market makes me more money. No, that's not accurate. Because then at like 10% return the stock market, that really comes from two things. A dividend, if the stock pays out on it. So that's like a quarterly cash flow they'll pay out. And capital appreciation. Great. You bought the stock for $100. Now it's worth $200. So that is appreciation, and cash flow is essentially what a stock is giving you. Now in real estate, you have the same thing. You have cash flow, which I think everyone's familiar with. And you also have appreciation, which is, hey, the prices, real estate generally appreciates over the long run. So those are two out of the four ways to make money. Now here's the other two. One is the debt pay down, because if it is an investment property, it's most likely your tenant paying down the debt. If I get $1,000 a month in rent and I have a $500 a month mortgage payment, well, my tenant is paying that $500 a month mortgage payment. And part of that payment goes towards interest and part of that payment goes towards principal. And as that principal gets paid down, it actually builds my equity. The fourth one is the most misunderstood, and I actually think one of the most fun one, especially right now, is depreciation or the tax benefits. Mm-hmm. And I could spend 3 hours on this topic alone, but like from the high level, we all hear, stories or, last couple of years, it's been, Trump in the news about, how these, billionaires pay no money in taxes. Well, a lot of times that is through real estate depreciation. And I don't want to get political or right or wrong, but like, hey, the reason they're not paying taxes because they are maximizing depreciation in real estate. And that is a huge, huge wealth building factor. You can actually generate a lot of extra cash flow, every single year that you own real estate, and of course, file your taxes.
So for people who don't understand this concept from a depreciation standpoint, to break it down, I mean, real estate appreciates, but you get to depreciate it from a tax standpoint. So how does that work, or why is that the case?
Yeah. I think an easy example where people follow along is, let's say, a construction company goes out there and they buy a Ford F-350, a big truck.
Mm-hmm.
Businesses can go out there and buy an asset, trucks, manufacturing equipment, office equipment, and they can depreciate it, usually like a 3, 5, 7 year lifespan. Real estate's the same way, where like the rental I bought last year, it's a house. And while the house is appreciating, going up in value, the IRS actually also allows you to depreciate the asset, meaning that they say, hey, the structure, the house itself, has a useful lifespan. So we actually allow you to write that off. And what that essentially does is it allows you to take a paper loss or a phantom loss on your tax returns. And let's just say I bought this house and I get $10,000 here in depreciation. So I actually get to show $10,000 of loss on my tax return, but I actually did not write out a $10,000 check from my bank. So I get the loss, which lowers my taxes. So if I am, in a 30% tax bracket, 30% at $10,000 is $3,000. Now I just got $3,000 back in my taxes.
Yeah, that's such an amazing tool. And I know some of my investor clients who have W-2, whether it's their own business that they're paying themselves a salary or they're employed, it makes a huge difference when it comes to tax. It's so much money every year that they're able to depreciate. It's insane.
Yeah. And I really got into personally, me as an investor, I really got into the depreciation game last year in full swing. And just the tax return I got just boggled my mind. And it was probably more than I got at any than any year my income in my 20s. It was just absolutely ridiculous. And I was just understanding the tax game and then being able to articulate it to my CPA. So another mistake I see people make learning depreciation, they go out there and they spend hours, or I say hundreds of hours over days and months and weeks trying to figure it out themselves. Don't understand the gist of it. And then go talk to your CPA. And if you don't have a CPA, get one. And if your CPA has no idea, well, then get a new CPA that knows real estate, because you don't want to learn the how. Make sure you get the who on that. Understand the concepts, and then find some actually go out there and execute it, because it is, it's IRS tax code. It's nuanced, and it's all layered on top of all different other write-offs and situations. And you do this, or you qualify for this, yada, yada, yada. So understand the concepts, but then get your professional sooner rather than later. Part of building your team.
That's super helpful. And I think that there's a difference between someone who files your taxes and someone that can help you with tax strategy. And finding someone that has that level of experience in the real estate investing world is so key for those two components of what you're describing. That's so helpful.
Yeah. And so kind of going back to those 4 examples there, cash flow, appreciation, debt pay down, and depreciation, tax benefits. If I go out there and spend $100,000 on a rental property and spend $100,000 on the stock gives me those 2 things back. So maybe a 10% return. But with real estate, I'll get all 4 of those returns back. Now, here's the second difference that moves the needle on real estate is, vast majority of people, especially if you want to maximize returns, if I put $100,000 down, I'm not buying a $100,000 house for cash. No, I'm putting $100,000 down as a 25% down payment to buy a $400,000 property. And so that leverage aspect is what really makes you the double-digit return, those really attractive returns in real estate, is using leverage, because you don't get that in the stock market. You don't get that in other investments. But real estate, it's about the easiest asset class, especially for, mom and pop investors like us and the average person out there, to go out there and deploy leverage. Call up any bank, call up a lender, and assuming you're good, they're happy to give you money, or loan you money, I should say. So understand the 4 ways, and implementing leverage is a very key way to understand the mechanics of wealth building in real estate. And then this is where I say the biggest paradigm shift comes for a lot of investors. Is a lot of times people, they understand those concepts and they go out there and they buy a property. Hey, I understand we use leverage, we'll make this money. Hey, buy this property, I'm going to make this cap rate, or this cash on cash return, or this cash rate, and different metrics in real estate. Great. Now, here is the biggest difference between real estate than a lot of other, like the stock market. If I bought this house and bought stocks 5 years ago, generally speaking, the stock and the mutual fund just automatically rebalance, they reinvest dividends, they grow. I set it and forget it. I do nothing. With real estate, though, it doesn't. There is no automatic reinvestment. And there's a lot of other factors in there that make it, that impact the returns. And so I see a lot of people say, hey, Greg, I bought this great rental 5 years ago and it performed so well. But when they come back and look at it today's numbers at the current, in the current value of, hey, the price, the rents, the expenses, well, it's actually not a very good investment a lot of times. And this is very common right now for people in Denver and just, a lot of other like markets, the way we've seen the appreciation last decade, is that property about 5 years ago, you can't use those numbers when you bought the property, and you can't use the same metrics to analyze how it's performing when you bought it. And so it's like so fascinating. And I can share like a graph with your listeners, Pam. But actually, a lot of times your return in real estate decreases over time. So if like, I'm making 25% this year in real estate, 24% next year, a lot of times after 7 to 10 years, it drops fairly dramatically. And that's because of leverage. If I bought the house with a 25% down payment 5 years ago, that means I'm 75% leveraged. Now, fast forward 5 years to 10 years, what's happened? Prices have appreciated and my tenants pay down debt. That increases my equity. So now I might be at like a 40% loan to value or a 30% loan to value. And this is where it gets really like trips people up because they see their cash flow has increased. They're making more money every month because their cash flows increased through rents going up, but their percent return on the money actually goes down. It's a really interesting like dichotomy.
It's counterintuitive for sure. Yeah.
Like, I'm making more cash flow. But then if you actually look at like the holistic amount and plug into a spreadsheet, you're actually making less percent wise. Does that make sense? Because it's like, it took me a good 9 months to understand it. And of course, we're trying to talk about like 9 minutes on the podcast now.
So what people should be thinking of at that point when they're at that stage where it's not performing?
Yeah, well, it really comes down to, again, going back to what we talked about at the beginning with the Venn diagram of like, hey, reevaluate, hey, what is your situation and what are your goals? The market's changed, your properties have changed, but most likely you have changed as well. 5 years ago, I didn't have kids. Now I have 2 kids. I think you're in a similar boat, Pam. Like life has changed drastically for us in an amazing way, but life has changed. And so that means my goals, my risk tolerance, my commitment, my desire to do things has changed as well. And so it's always really important to come back and like go back and revisit your goals and your situation. And then you have to go through and actually do like an analysis on your portfolio and your properties. And this is like what I enjoy doing the most. Like it's kind of like what I fell into and just I'm very passionate about it because very few people talk about it. But you go through and analyze the properties. And in a nutshell, you basically analyze it at all of today's numbers. What's today's value? What's today's rents? What's today's expenses? And then you get to see what the true return is based on how much equity you have. And then you can compare scenarios. Hey, should I keep this? Should I sell it and then trade up to buy something else? Should I refinance it? Because there's usually 2 types of people. People that still want to acquire more real estate, more future wealth, more future income. And the people like, you know what? I'm kind of good. Now I want to start like realizing more cash flow. I'm getting old. I want to retire. I'm kind of out of my acquisition mode and more in my just, retirement mode. It's the same thing as like people go from like a very high stock allocation when they're young to like a higher bond allocation as they get older to reduce risk and increase cash flow. So the key point there is your goals, reevaluate your portfolio, and it's going to come back to the same dynamic of if you want more returns, you have to re-leverage. Re-leveraging is the biggest return factor in real estate. And so through that, what people usually do is like a cash out refinance or HELOC to pull out equity, or they sell the property, utilize a 1031 exchange, which defers capital gains, and then buy a new property. But either way, you want to take that equity you extract from the property and invest it in another asset, and ideally another better performing asset. So re-leverage and buy a better asset are the two key messages there.
And how often is this portfolio analysis that people should be doing annually, every 3 years? What's your kind of recommendation?
I think every year. I mean, it's just like for a lot of things, you have your annual health checkup with your doctor, or we all should, do it annually. A lot of people have financial advisors. And they do, an annual checkup. In times like this, it might be monthly with the stock market being so volatile. But I think an annual checkup is really good. And not just the numbers, but also looking at the operational side as well. I'm looking at the overall, just like, hey, how is that investment business running? Because this is not the stock market. This is a real estate business. It is still a business, even though you're investing, and you have to take care of a lot more items. So, hey, what are my goals this year? How am my property performing? Are my rents up to date? The number one mistake I see from people, I work with clients and people hire me to look at their portfolios, and it's like, hey, shouldn't make any moves, but raise your rents. Like, you are $300 below market rent. The best thing you can do is actually just go out there and raise your rents. And that usually means like they either get a better property manager or they fire themselves as a property manager. And of course, there's always, do you raise it all the way? There's, it's a very nuanced question, but the biggest mistake I see people see is like their rents are not keeping up with the market, especially in, just we've had appreciating rents of the last couple of years and people are below rent drastically. So short answer is I would do it every year. That's what I do for myself.
And then you mentioned a lot of different metrics that people should be doing in this analysis. And I know you have a tool that people can use to do it. Can you talk a little bit about that?
Yeah, I would love to. So the tool we have is called Property Llama, and it's a online real estate software that helps people actually do what we talk about. Analyze their portfolio from the global view. Hey, I own 10 properties. How do I look from a global portfolio view, which no one ever really does for their real estate because it's on 10 different spreadsheets. And then you go through every single property and do an analysis. You do a property by property analysis, and also, how do you like owning the property? A lot of times people have very strong emotions, better or for worse, on properties. I love this property. I hate this property. Great. That's worth to note in the investment strategy. But what this tool does is actually it takes a lot of the same metrics that I have compiled over the years to analyze my own portfolio, that I've learned from people much smarter and much more successful than me, and it actually puts it in there and gives you recommendations on what you can do. So the goal is to make it like a mint.com or like a credit card. Actually, creditkarma.com is the better type of example where, it tells you like, hey, look at this, do this, do this. Lots of great tools out there for personal finance, for stocks, but nothing out there really for real estate. And we are trying to fill that gap in the marketplace. And it's really, it's a combination of having the software tell you the stuff, but also having like some human advisory, like your team helping to explain it, which is a lot of times, the investor's realtor and lender are a lot of times like their main players or main team members in their real estate game.
Yeah. And I've kind of demoed the software, and I love that the interface and how easy it is. And it really puts all that information. And I think you kind of talked a little bit about kind of the emotional component and kind of the trigger component. And what I like about this is it's doing the math. And so it can take, when you have something very concrete to look at, it can take a lot of that mental drama out and help you think more critically, which is so helpful.
Exactly. And that was one of the main goals we wanted to do, was just make it objective, and just give people a reality check, for lack of better words.
So for people listening, if they want to get in touch with you or they want to learn more from you, what are the best kind of platforms, places for them to connect with you, Chris?
Yeah, I would say a couple of things. I mean, I run the Denver Real Estate Investing Podcast. So if you want to invest in Denver, really good podcast to listen to. You can Google that, will pop up. But the other thing, and really more along like that wealth building mechanics, is we are going through a lot of growth right now to really build out advisory to help people analyze their portfolios. And so if you want to account with Property Llama, and it's free to use, we can put a link in the show notes, but you go there, put your properties in, it'll help you analyze your property. And then what we're getting in the habit of, and actually something we're launching very, very soon, is what we call our portfolio analysis masterminds. And it's actually a way for people to go in there, plug in their properties, but in like a group format, go through and learn those key metrics. Some of what we talked about now, learn those key metrics, and then go out there and actually like do their own portfolio. We'll also do it with a group of like-minded people. I think having community and networking is so important. So having a lot of people do it together is important, since many investors are on an island by themselves. Their friends don't do it. Their spouse is like, all right, cool. Okay, we invest in real estate, but you take care of that. I don't want to know. And so it's very powerful in bringing people together so they can network, learn from others, while also seeing what their portfolio is doing and exploring for potential opportunities as well.
That's amazing. And I know I did kind of a strategy session with you earlier in the year, Chris, and I was just blown away. And I've talked to so many different people and getting ideas, and you really put things in a simple way that made me realize, hey, the house we're in, we're thinking of getting a new house. Should we hold it as an investment property? I would say like 99% of the people you talk to are like, yes, you should keep it as an investment property because of appreciation. And then we looked at the numbers and it's like, no, that really isn't the best idea. I should be leveraging it and allocating it, repositioning it into something that's going to have kind of meet those four mechanics. So I love the idea of kind of the group format. Does Property Llama or do the tools that you have address people that are investing in syndications or investing kind of with groups of people, and if not, what recommendations do you have for people kind of evaluating those types of investments?
Yeah, the software currently does not. That is actually one of the things that it's in the very near future start building out, because ultimately we're building the software for like what we want as investors. Like, oh, I want this. It's like our dream tool and dashboard. And we are very early on in our development process, and so very early on in the marathon of it. So currently it doesn't. We want to add it there. I'd say the biggest thing in evaluating those types of deals is, it's half numbers. But I actually spend a lot more time underwriting and getting to know the operator or the person putting together the deal. Because ultimately, like those syndications, investing in real estate funds, they are financial security products. And, they become very popular the last, I think, about decades, since, a lot of the rules changed around it. And I see a lot of people out there promoting it. And I'm very much behind the scenes and plugged into what's going on. A lot of the people putting those deals together, I would put in the category as like a fake it till you make it type person, where they don't really have the operational experience in running a property or running a deal, nor the experience, nor the financial capability to make things right. Like there's a lot of people that are new, no money, and they're raising money to put deals in. That's great. And for that number of years, it's worked fine because the market's just been, so bullish. But now with the market changing, things can go sideways. And so I actually think understanding the operator to know, like, hey, what is their experience? What are they investing in the deal? Are they putting skin in the game? And if something does not go according to plan, do they have the capacity from a financial standpoint to write a check and make up for it? So I like to look at operators that way, like, hey, you got skin in the game, you got experience, and it's a matter of when, not if. When something goes wrong, may not be this project, but maybe 5 projects down the road, get a black eye, or, hey, we bought this, and then the market just went to crap because of COVID or because interest rates doubled. It changes the business plan. Can that person adapt, pivot? And a lot of times that means also running a check in there to keep the property going. So I think it's half the business plan, but half the operator, half the sponsor.
That's super helpful. Well, Chris, the last question I ask everybody on the podcast is, what is your legacy? What is the legacy you are building?
Oh, it's a work in progress. So I'll say that. Actually, I love asking this question to just like, mentors that I have myself. So I look at it from a couple of standpoints, like for like my family, myself, and also from like a business standpoint. For my family, really for like my kids and, hopefully my grandkids and great grandkids, if I get to be that old. Right now I'm debating on like, how much do you leave them? Monetary, because I expect to be, very wealthy when I die, and that's one of my goals. But I'm like, well, do I want to take that away from my kids because they need to earn it themselves? Very different. You go out there and do it yourself versus, oh, I'm a trust fund baby. I don't want trust fund babies. So it's not so much monetarily. So I'm debating on like what to leave that. And that's hopefully many decades away. And thanks to working with you, actually, I'm the estate plan in place, Pam. So that helps out a lot.
I was like, we're going to have to update things, Chris, now that with your evolution of what you're thinking. I'm taking notes. No.
Yeah, good. Because I need your help on this. But I think for me, it's more about I want to leave the world a slightly better place than I came into it. And that's like through what I can teach my kids and like them going out there and, you know, being good human beings, them going out there and doing something that does have an impact and change in the world. And from like a business marketing standpoint, you know, real estate investing is a very capitalistic business. It's about making money. It's about creating wealth. While most people, you know, they also want to go out there and put out a very good product for their tenants to live in. Like, hey, I want to have a great house, a great condo for my tenants to live in. So you're still helping people. But I take the philosophy that if I go out there and help through education, through, you know, brokerage services, advisory services, software service, I can help a lot more investors reach their goals. And if they go out there and hit their goals or achieve financial freedom, everyone out there has their own passions and charities, and actually helps them go out there and change the world in their way. So I think I can have like a very indirect impact in helping people change the world by helping them achieve their goals.
Well, that was amazing. Very powerful. And thank you so much, Chris. This episode was so powerful. So many great tips, and look forward to sharing the show notes, all the links that Chris has given. Thanks again.
Thanks, Pam. This is a blast.
If you need an updated will, trust, or estate plan, and you are a Colorado resident, we would love to be your estate planning law firm. Give us a call at 720-706-0036 to schedule your complimentary 15-minute call. You can also directly schedule at lawmother.com/go. If you liked this episode and you want to learn more, you should definitely check out my international best-selling book, Legally Ever After. It's available on Amazon as both an ebook, a paperback, and an audio version. And if you'd like a free chapter, head over to lawmother.com/LEA.